The share market dropped 1.7% today with falls everywhere. Miners, retailers, tech stocks and banks. And speaking of banks, angry ANZ shareholders stripped CEO Shane Elliott of $3 million in bonuses today at the AGM. And the Aussie dollar briefly dipped below 62 US cents for the first time in 2 years and is currently changing hands for 62.2, down quite a lot. And note that it actually rose against the Kiwi, which I'll come back to in a moment. The reason for today's big falls is that in delivering a fully expected 0.25% rate cut last night, the members of the US interest rate setting board reduced their forecasts for how many cuts there'll be next year from 4 to 2. Now, publishing these predictions is all very well, but do we really need to know? They're usually wrong anyway. As Yogi Berra said, predicting is hard, especially when it's about the future. Anyway, the impact on markets was dramatic. The US dollar went vertical, as did the US share market in the other direction. The S&P 500 index fell 3%, the Nasdaq 3.6%, and the biggest fall was Tesla, down more than 8%, having doubled since the election in November. Asian markets also fell, but not as much as America's. Now, one of the more interesting investment metrics is the fools to money ratio, measured by total share market value relative to money supply. When there's more money than fools, prices go up. When there are more fools than money, prices go down. This chart shows the American money to fools ratio and explains why prices have been going up. And today we were reminded that it can flip pretty quickly sometimes. And finally, New Zealand. Its GDP shrank 1% in the third quarter, and the previous quarter has been revised down from -0.2 to -1.1. 2 consecutive quarters of shrinking GDP is officially a recession. And that's finance.